Hello, guys. Gotcha.
All right. It's probably gonna be just me today.
Just you
Mike,
today? All right.
I think Mike got a meeting. And,
All right. And how about Cleveland? No Cleveland today?
Yeah, he not here today.
All right. Personal one-on-one. All right. So you can see my screen okay?
Yeah, I can see it good.
All right, perfect. So we'll go ahead and get started. So today we're going to be talking really about day trading versus swing trading, right? And as always, with the disclaimer, right? Oops, everything that you see is for educational purposes, and you've hopefully been paper trading, right?
Yeah, I have.
Yeah, good. How's the cutting the losers? How's that going?
I don't have a problem with it. I don't feel like I have a problem with as far as like whenever it gets to the point where I set of course I set a stop and on both ends. But whenever it gets to the point where it's not going my way, I don't have a problem with cutting the losses.
Okay. Very nice. And how about letting the winners continue so that you can capture gains?
That's my problem right there. As far as because like sometimes maybe it was yesterday that KXIN I got a decent little trade off of it, but it ended up kept running. I got it early in the morning. I probably got it around 7 a.m. Mine was probably like a 45-second trade.
It can happen like that on those really low float stocks.
I was in and I was out, and it just happened to keep running like all day. But in my opinion, that trade setup was over with. Because of when I entered, um, and when I exited, like the stock, like it dropped. So I got out, and maybe I could have got back in, but I didn't want to mess with it no more after that. So it ended up kept running for like most of the day, and it went up a lot. So
did it ever come back to your entry price and drop below it, or did it always stay above your entry price?
It went below my entry price.
Okay.
So I took some profits on the way up, and whenever it came back down to my entry price, I just sold it all.
Okay. So you ended up having a great trade out of that. And the only thing you might have wanted to do is take partial position off, right? So if you'd taken, say, 75% off at your target and then you put a trail, then maybe it depends on how far down it pulled back, right? If it pulled back, 50%, I don't know the exact numbers on it, but if it had pulled back, maybe just 5 cents below your entry and then surged higher, you could have left a little bit of a trailing stop on that last portion. And then if it continued, then that last portion could have continued up a lot of the day. Because sometimes with taking profits, when you take most of it off, it will allow you to stay in the trade more because your position size is now smaller, your risk is smaller. And so you're able to let it come back to your entry point. However, if you were to see, hey, look at all this volume that's coming in and it's holding it right here and then up it goes, it will end up providing more profits because you haven't necessarily taken everything out. But taking a profit is never a bad thing. It's always a good thing. That's how you're going to grow your account.
I just wanted more than that. I mean, I ain't trying to be greedy. I get it. But it's like, they got a couple of people that we follow, I guess, on social networks and stuff, and they'll come and show, well, yeah, I just made 15,000 on the same trade that I did. I just made 15,000. I'm like, why didn't he get out? Whenever whenever it came back down to the original price, but hey, whatever.
Yeah, but you also have to remember that it's going to come with experience, right? And your comfort level, you got out when you were ready at your comfort level. So that was the right trade for you. And again, everybody trades differently. And there's a lot of people out there that will say, hey, look at how much I made. And that's a more an ego driven trade. If you get into it and you're just following the rules and the path of the trades, then you're going to end up being more profitable. And it doesn't need to be something where you're like, hey, look at me, I made all this money, because
Right,
that's almost like being a sore winner, right?
right.
If you go and like when you're a little kid, it's like, oh my gosh, we won, no, 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 no. It's like, oh, great, that's good for you, you know? But ultimately, it's the experience in getting there. Next time, the more confident you are, potentially the bigger position size that you'll be able to take, and you'll lock a bigger gain. So you also don't necessarily know how large their position was at the same time. You don't know how many shares they were trading. I don't assume you don't know, but they might have gone in with a large amount, or were they also trading options on the stock, because then maybe they made a huge gain on the options instead of just on the stock.
But they were trading shares, you
Yeah, they
know.
were. Okay. It's possible. For sure, it's possible. Like I said, you can have some amazing, amazing trading days, and then some other days are going to be small. It's just keeping them consistently green. Are you there? Seems like it froze.
Hey,
Oh, there you go. Okay, cool.
yeah,
I was just about to message you on Twitter and say, hey, where are you?
I don't know what that was.
I think it froze. It was probably the internet going in and out. All right, so strategies are best paper traded, and once you know that you know the risks, there's a risk in trading all sorts of securities instruments. No past performance is indicative of future performance. All right, moving forward. So we have high frequency trading. That's going to be really the computers, the algorithms that are really trading super quick, milliseconds. And
Right,
then we have day trading. That's more intraday, right? So you open it today, you close it today. Swing trading, we open it today, close it anytime later after the close. So after midnight. So tomorrow, a week, 2 weeks, a month. Position trading could be seasonally, where you're going to ride it just for that season up. You ride the trend and you're done. Then you have the buy and hold investor. This is more like the dinosaurs, the Warren Buffett's put the money in, let it grow. Just leave it and let it grow as exponentially. The market is bullish because people are always pouring money in with 401ks. And a lot of what we've seen after the drop in February and March was that, hey, all these people saw that the market was at a discount. They started buying it up. We also had the really big guys that were buying it up, and they're just moving it up. And this is a little bit more of a breakdown. So we have the intraday trade, where you have, say you open it anytime after market open and you close it again, usually before close. However, you could close it during the extended hours and it would still count for today. It's all taking place on today's date. Then you have swing trading. So you open it up today and today is Tuesday. You close it Wednesday or later. And of course, we encounter the PDT rule, right? So this is for traders in the US, and it's set up by the SEC for people that have a account that is less than 25,000, and it's a margin account. So basically greater than 2,000 and less than 25,000. Most requirements to open up a margin account are a minimum of $2,000. And that's
What if you have a cash account though? Okay, so it says that hold 25 in the margin accounts. What if you have a cash account?
cash account is different. You are not obligated to follow the PDT rule. However, the reason why the PDT rule is tied to a margin account is because in a cash account, when you use that money, if you have a $1,500 cash account, right?
Right.
and you make a trade, you use $500, you open it at 500, you sell it at 700, you have to wait
The funds are set
today
up.
plus 2 more days to have that $700 available. So you're
Right.
not able to reuse that money in a cash account as a day trader. It forces you to have to wait. It's the margin accounts that give you that money back immediately, right? So if you were to open it, you have a $2,000 or $1,500 account, you trade 500 of it, you sell it for 700, you now have $2,200 at your disposal, plus the margin ability, right? So it would actually turn from 3,000 up to 4,400 because it's usually 2 for 1, right? So if you have 1,500, then you have $3,000 of ability to trade with. So the PDT rule is for people that have less than 25,000. Now, say one day you close your account, it's 25,000. You're like, yes, I am done with this PDT rule. You go, you rock trades the next day, you go down to 24,500. Oh no. Guess what? You're right back under the PDT again. You
Is that
have
for the
to,
whole? Is that for the whole day, or is that as soon as it happens? As soon as it happens, okay, now you're under the PDT rule.
it's for the close. So it's at the
Okay.
close of day. That's really important, right? So if you're on the cusp, you want to be careful. You don't
Right.
want to, it's best to open up with like 26,000 because you want to have a little bit of a buffer. You don't want to
Right.
be stressed out every single day. Oh my goodness, I've dropped down below 25,000. Now I have to be extra careful. I have to abide by the PDT rule. And here's another breakdown. So the PDT rule are 3-day trades, so in and out in the same day in a rolling 5-day period. It doesn't have to be set up like this: Monday, Wednesday, Friday. You could have it where you trade on Tuesday and Wednesday and Friday. And you have to wait until that 5-day period is done before you could trade these other 2 trades, right? So we have at least 5 days here. So it's 1, 2, 3, 4, 5. So you could trade on Wednesday, but maybe you do 2 trades on Thursday and another on Friday. Then you have to wait all the way till Friday. Then you have all of your 3 trades available again. Does that make sense to you? I think it froze again. All right, you're back.
I don't know why I keep doing that.
It's all good. It's all good. So I don't necessarily recommend this. Looks like somebody's trying to come in. Let's see. Hello? Is that you?
Oh, wow.
You got me on the big screen?
Yeah, I think it's see, because our regular computers had went down, and
Okay, do you want me to kick out the other?
let me see how it is. Okay, that's fine. You can just do it on the big screen.
Just hit, oops.
You say what?
I was gonna say if you hit mute on one of them, it'll be okay. Then you'll hear me. Yeah, I don't hear you on the other one yet. Oh, you can't hear me now. All right. I can kick the other one out if you want to just stick with the iPad.
All right, that's fine.
Or I'll just mute the other one. How about that? I'll remove it. There we go. Okay, now we're just on the iPad. All right. So you could theoretically, if you didn't have $25,000 to start. I have no idea of the capital that you are looking to start with. But if you had maybe less than that, you have $10,000. You could do 3,000 in one account, 3,000 in another account, and 4,000 in another. So if you had 3 accounts open, you could do 3 in and outs. Excuse me. Yes, 3 trades per week in each account. Does that make sense? So you get 9 trades for
Yeah.
every 5-day period instead of just 3. So some people, when they're starting out, will do that. They'll spread their money around. Now, obviously, you can't take as big of a position because you've got money that's dispersed in different accounts, but it would give you the opportunity to have more trades. And then maybe you build up the capital in those other accounts. All of a sudden, you have over 25,000. You could consolidate them into your favorite platform. And next thing you know, you're rocking and rolling and you don't have to abide by the PDT rule.
I kind of did it. I wanted to use Thinkorswim because they have OTC too. I like Webull because of their hours, and like if they have something pre-market that I really want to get, I would get it off of Webull, and I just like Robinhood for the options. But honestly, if Robinhood had the pre-market and the OTC and stuff like Thinkorswim, it would probably be a lot better.
Yeah. Well, I mean, they're probably limiting themselves to what works for them and what's bringing in the majority of their traders. So I don't know because I've never traded on Robinhood or Webull, so I couldn't speak about the platforms. But Thinkorswim tends to be pretty good. Charles Schwab has amazing fills. If you ever look into opening up an account with them, they've got very, very fast fills. When I do a market order for options, I will usually get the bid price, not the ask. It'll usually execute on the lower, which is great. You know, if you're going into it, if you have a large number of options, if you're getting a penny off, $1 off, a bunch of options, that's even better because then your profit margin is going to be greater.
Oh, so you buying and selling options too? I don't know why. I just assume that you day traded.
Yeah, I do everything.
Okay.
We're gonna talk even a little bit about futures today too. Not about trading them, but why they're really important. So let's continue forward. All right. So entering the day trades, right? When do you want to enter? So you want to enter in that first hour. You can see here by the picture for this Apple example, that first hour we have the most volume. And the last hour, that volume is going to increase again. And you want to be in and out, really getting into a trade when there's a lot of volume, and you're going to want to get out in strength, right? You don't necessarily want to get out when there's a lot of weakness, especially if you're trading a high momentum stock. When it starts to go against you, it can go against you very quickly. So that's why, you know, you'll see people that are using hotkeys because as soon as they see it turn, sometimes they'll go ahead and execute with that hotkeys. So you can get right out. And also starting at 2:30, 3 o'clock, 3:30, and 3:45, that's really when margin calls start to go out from the brokers. So you will see a lot of volatility and volume starting from 2:30 until 4 o'clock because now the brokers are saying to all those people that have margin, hey, you have shorted this stock, for example, and now it's going up like KXIN. It's going against you. We're going to need you to close out your position. You have until 3 o'clock, right? And maybe they don't close out their position. So then you might see right at 3 o'clock, there's a spike of volume and it will go up dramatically. Or maybe they'll give them until 3:30 or 3:45 is really that make it or break it because they'll say, you know what? You are a liability in our books and it's going to be higher margin requirement for you to hold these stocks overnight than to day trade them. So they'll force them to close out some of their position or all of their position.
Force them to do it? Like, okay, so if they shorten something, which I know it can go far, don't they, like is it a certain amount of time that they get? Like shorten the stock, it's not like an option contract.
No, but here's the thing. Say you are here, let me go forward because I'm going to show you this too. So here for the day trading, right? Say we've got Do you want to enter IBM today? It was a great short off of the watch list and it broke below 121. It broke below early in the morning and then it came right on down. Well, so maybe you're holding it, but you know what? Maybe at the end of the day, it closes up and it closes up high. Well, you see, all these people that might have started the day opening their position are now closing it out end of the day. You also have big institutional traders that aren't allowed to hold it overnight. But if you were, say we're shorting the stock, doesn't matter what it is, doesn't have to be IBM, but it's closing up and we'll call this the closing candle and they shorted it down here, right? Well, now it's gone against them. And remember, they have borrowed these shares from the broker. So depending on how much of their margin that they used, they might be at their margin. It's like using a credit card and they say, hey, guess what, you have reached your credit limit, or
Right.
this purchase is too much for your credit limit, so I'm sorry, we're going to refuse it. So holding it overnight is them saying it's a little too much liability on our books because you have this credit agreement with us to short stocks, and so we're sorry, but you're going to have to close out your position. Now you can also ask them, you could say, hey, wait a second, is it okay if I close out 50% of my position? Is that going to, increase the margin requirements so I can still hold some overnight if that was looking like it's part of your trading plan? However, usually they have a whole risk management team in their brokerage firm, and they go and they look at the accounts that are higher risk, right? So that they're meeting their margin requirements. And they'll say, or excuse me, they're close to exceeding their margin requirements. So maybe they'll say, you know what? This position is going against you, and we'd prefer that you would close this out by 3:45 today. Are you willing to do that? Yes or no? And then if you don't close it out, they might call you back at 3:45 and say, all right, listen, if you don't close this out before end of the day, we're going to close it out no matter what the price is.
What?
Yeah. Yeah. Because it's a credit agreement. A margin agreement, that's now I'm not talking about if you're just in general shorting a stock. I'm talking about if you are reaching your margin maximum with the
Right.
broker. It's a liability on their books. And if it were to have gone against you, say, and now you've exceeded your margin ability with the broker, they have the right to call you before open, or even before open, close it out. And they'll typically call and say, hey, this has gone up 100% overnight. I'm sorry, but we're closing out this position as soon as market opens. And then it doesn't matter. You owe them that money. That's another reason why when you're trading short stocks, you better know. I mean, it's hard to know anything 100% in trading,
Right. Right.
but it's a possibility where if you hold it overnight short, that you could get squeezed. Even if it's in a bankrupt scenario, look at Hertz, right? Hertz is going through Chapter 11 bankruptcy. So just because it's going through bankruptcy, everyone's thinking that's where they're getting themselves in trouble. They're thinking fundamentally, this company is not doing well. It's not creating sales. They're in the tank. There's no money coming in. So therefore, I'm going to short this stock. Well, then news comes out that they're going to restructure, and all of a sudden, they've gotten funding to help them with the restructuring plan. Overnight, it goes up 100%. And at that time, when it went up 100%, there was over 60% short volume the day prior.
I almost feel like we need to have a section on bankruptcy because okay, so like JC Penney is almost like on that verge too, going bankruptcy
Right.
too, right?
Mhm.
So at what point are they good? Like, because I'm hearing like they might be getting funding too. So like, is Hertz good now?
Well, here's the thing. They're still going through bankruptcy, right? Hertz is still going through bankruptcy. So it's that the Chapter 11 versus 17, I think it's 17. 17 is more like dead in the water. Chapter 11 means that they're going through the court and they're trying to restructure how they're going to pay off their debt with their creditors, right? But either scenario, the shareholders are at the bottom, right?
So
And
chapter 17 is the worst.
yes. Is it 7? Maybe it's 7 and 11. I think it's 7 and 11. I think my mind put the two together. I don't know. I've never been through either one, so I wouldn't know.
Right.
But let's see. Bankruptcy. Well, 11 is the one where they go through and they're able to restructure. I know that much. Trading at chapter 11 is better than trading the other, which I think it's 7. It's either 7 or 17. I can't find it right this second. But bankruptcy chapter 7. 7 years. 7 versus 11. Must be 7. Chapter 7. Yeah. All right. Oh, there's 7, 13, and 11. There you go.
So what's up with 13?
13. Okay, chapter 7 is a liquidation bankruptcy, so that's not good. They're liquidating everything. Chapter 13 is a reorganization bankruptcy designed for debtors with regular income who have enough left over each month to pay back at least a portion of their debts through repayment. And chapter 11 is where they're restructuring everything.
So chapter 13 versus chapter 11.
So chapter 13, they're still paying it off, but they already have their income coming in, right?
So 7 is the worst, 11 is second the worst, and 13. Okay.
Yeah. Okay. So in trading, day trading, we totally got off topic over here. In day trading, right, you can see that in the beginning of the day, the first 15 minutes are going to be really volatile. You have wide price action and you have a lot of volume. Again, that's from all the orders that are stacked up from the night before, from 4 p.m. until 9:30 a.m. People are reading the news, they're looking at everything, and they're like, all right, I'm going to buy this, or it's gapped up, I'm going to sell this. And you have all these orders stacked up. So it's very, very volatile because the brokers are in the interest of the brokers are in the interest of order flow. That's how they're going to make part of their money, is that when their orders are filled, then they receive a fee from the exchange. And so when we look at it, the retail traders, you and I, being a smaller retail trader as opposed to an institution or an algorithm, look at it and we say, hey, I want to get in when there's volume and I want to get in when there's a lot of volatility. So I need there to be volume for me to get in and to get out. When there's no volume, it's not as easy to get out because the price likely isn't moving very well, or it can move against you fairly quickly. Like here, you see after 11 o'clock, we like to say that's minion time. That's when the algorithms start to take over. Most of the retail traders are out of the market and they'll trade it up, they'll trade it down, but there's not a lot of volume. This is a little abnormal in that this had earnings today. And so it still had a little bit of volume in the middle of the day once it broke, but you can see it broke the resistance line right here. That's where the volume came into it. So it broke a resistance, a little bit of a double bottom, and it started to curl up. Now, end of day again, as I said, 2:30, you see the little increase of volume right here. That's the margin calls. That's people getting out of their positions or closing out their positions for the day. And many times you'll see more day traders coming in for that last 2:30 to 4 o'clock. Really 3 o'clock is when the margin calls really start going out. 3 o'clock, 3:30, 3:45. And it's really that last 15 minutes, it's wild and crazy again, because people are exiting their positions. They are clearing their book. Day traders are clearing their book. Institutional traders, prop traders are getting out. For the really big hedge funds, they're still holding on.
So the end of the day is a good time to short?
No, I'm not saying short. It's a good time to trade because there's a lot of volume. There's a lot of volume that's happening and usually a lot of price activity.
If they weren't about getting marginal calls,
then it might go the other direction. You would expect for it to go up, right? Like it did over here. It went up, then it pulled back, and look at the last 5 minutes here. What happened? It went the exact opposite way, right? Then all of a sudden, all the shorts are covering, then some longs might be getting into it. And this was right before earnings, so it's a little choppy too, the last 5 minutes of the day. Make sense?
Yep.
Okay. So when you're looking for that day, this is for when you're looking for the day trading setups, right? You need to have volume, usually at least over 100,000. All right. You want to make sure that there's good price volume action, right? You need to have that volume to indicate that you're going to have movement in that stock. And you want to have a gap in price movement, whether it's up or down. You want to have a catalyst for some reason. You want to have something that's spurring the motion. So this is from today, and this is from Market Chameleon, right?
What is from what?
Market Chameleon. Here, I'll give you the link. You can get to them for free. Hold on. And it's I like using this if I'm traveling because you can get into it. You can get in and out of, or you can get the information early in the morning, right? And you'll see, all of this is free. It's not going to charge you anything to use Market Chameleon. You can get access to it. I think it froze again. Can you hear me?
I can hear you.
Okay, good. All right. All of a sudden the picture freezes and I'm like, uh-oh, I'm talking to a wall. All right. So you can get the action free in the morning, and you can also sort it. You can click on one of these columns. All right, I want to see the biggest percent change. I want to see the biggest gainers, or I want to see the biggest volume. I sorted them based on volume because that's what is the most important to me. What is going on with the volume? If there's a lot of volume, there's a lot of people interested in this, right? If there's a lot of interest in it, it's going to be active today. You want to day trade only active stocks, right? Are you guys using anything in particular for scanning for stocks right now or no?
I use a little Finviz screener, but I usually my volume is usually probably about 200K.
Okay. You could go with 100,000. And what time are you looking at it as well?
I'm looking at it Central Time, probably about from 5 a.m. to about whenever I think it's from opens at it opens at 6 a.m. for us. So from about 5 a.m. to about 5:45ish, getting it ready.
Okay. Nice. All right. They will have this. So 6 a.m. they'll have it here for you too, if you want to use Market Chameleon. And I like it because you can sort it very, very quickly. You can see the price change. You can sort it by anything. And then you can go and look at the chart. And it will tell you if, hey, are there any alerts going on, anything like that. But you really want to have, number one, volume, and you want to have that price movement to get into a stock that's good for the day. Good? And again, minion time, 11 to 2:30, a time where I personally am not in front of my computer doing any trading. I will go for lunch, I'll go for a workout, I'll go and do my grocery shopping. Whatever it is, I'm not in front of the computer because on average, when I look back at my trades, they are not winning trades. So why even subject myself to being in front of the computer and being tempted? Now, some days, like today was an anomaly with the SPY in the middle of the day because of some tweets that happened, and then the price action started going crazy, and there were opportunities today. But it's not always like that.
Okay.
So for day trading, I recommend middle of the day, take it for yourself, go in and do something else, change your mindset. One of the trading rooms, that I'm in. There's a real estate developer. He sets up all of his meetings between 11 and 2. So he's not even tempted to be in front of the market because it's on average like 90% of the time the algorithms are at work, and you will see that the price action will be wild and crazy and it just will not make sense, and it's because a computer's in control of it. And why subject yourself as a trader to being in crazy price action like that when you might as well just wait for those 5-star setups or the grade A setups instead of one that might be mediocre.
So between 11 and 2, you can have the setups and everything, but
it will be harder because most people, as a day trader, how many people are posting that they've had great wins after 12 o'clock in the afternoon?
not a
I'm
lot.
serious, right? Like, how many people are usually saying, hey, I'm done for the day. This is what I did today. And that's because they also know, hey, you know what? I've got experience in this. I'm closing up shop. I'm going to go and do something else. And then I'll come back for the last hour of the day. Because it's not really you will learn more. The more time you sit in front of the computer and the more time that you watch, you will see that the price action in the middle of the day is not the best for day trading. And I highly recommend paper trading at that time and seeing and charting out. I have to give you the link for the trading journal too. I'll do that. That you will track it and you'll see that that's not the best time. I mean, maybe you'll be amazing at it, but I think 85% of the traders that are retail traders are usually done by then. You think about it too, all the movies, they're out having their 3 martini lunches, right? Because there's not that much action in the market. They're celebrating their mornings, and then maybe they'll go back in the afternoon.
So you don't trade after hours either, ever?
After hours and pre-market, very rarely, simply on the fact that it is an earnings trade. Okay, maybe, because there needs to be that volume, right? So if there's a lot of volume pre-market, if you were in like KXIN, probably you had a lot of volume pre-market. You see a lot of bids and asks, and the spread's not that crazy. All right, okay, that's something that would be interesting. However, if it's something that you're looking at the level 2, and maybe that level 2 is saying, a $6 spread on the stock because it's just not trading, I have no interest in trading that. It's better to wait until the actual trading hours when there's more people looking at it, more people have accessibility to trade it, and it'd be easier to get in and out. Right? It's just a little bit easier when you have the entire world being able to have access to it instead of pretty much just the brokers that you're dealing with.
Right.
Right? Okay, so best times to enter swing trade, right? Maybe we actually have Netflix having earnings tonight. So maybe you're thinking, all right, maybe you're looking at it at the beginning of the day and you think, all right, look, it came up, it hit this high, I'm totally shorting this, right? And you short it at the open of day. And then you're like, well, you know what? I'm not taking any profit, right? I know it's going to go down here, right? This is the blue line. It closed down here yesterday and it's already pulled back. Well, it's going to pull back further. Well, you don't, right? And then you have opportunities to potentially close it out. Maybe you want to close it out right here, but you don't. And then all of a sudden it goes against you, and then you're in a short and it's going against you. You now have a loss, and then you end up swinging this, or you leave your desk and you end up swinging this, and next thing you know, it's all the way up at the high of the day when you look at it at the end of the day. Not a position you want to be in. So when you're swing trading is capitalizing on that overnight action, right? It's not throughout the middle of the day, it's what happens overnight. The anticipated gap, in that you're trying to look for signals that it's going to give you an opportunity to swing it overnight. So if you want to swing it overnight, when do you think you would want to get into it?
As far as the time,
Mhm.
um, in the last hour.
Mhm. Even more specific, the last 15 minutes. You want to see the most data possible, right? You want to see how it's performed throughout the entire day. Because if it's going up, you see here on this Netflix, it came all the way up to 316. Up, maybe some people were taking profits. Maybe those are margins that were holding it long. So they took their profits, they brought it back down. And then where did it close? It's 5 minutes. So actually, this is more like 3 o'clock right here, 3:30, maybe 3:45, and then we're right at 4 o'clock. So you can see that last 15 minutes, you really want it to hold up at the end of the day. You don't want to have a big selling spike where you've got a little wick on the candle, right? That doesn't mean that the buyers are taking it up. That means that the sellers brought it back down, right? So then there's still selling power on the stock if we're looking at this as a candlestick. So you want to get the most data possible for the day, and you also want it to have higher volume for that day, right? So
At the end of the day.
for the overall day, you want it to have higher volume. End of
Okay.
the day, in general, you'll see it will have high volume because of everyone that's closing out their positions. So the open and the close always have, you can see it here. Usually the open and the close always have big volume spikes. But when you're looking further, you want it to have a bigger volume candlestick, right? So you see this one's a little bit bigger. This one's a little bit bigger here where it was, oh, I don't know what that is. Or this one's a little bit bigger, right? So here is a good example of a short, right? You see right here, this one is closing weak. So I came up with a good slogan. We'll go back one and then I'll come right back to it. If you want to go long, you want it to be closing strong, right? If it looks like it's time to abort, like jump ship, then you could short. All right. So here's the first one is a potential short opportunity. It did have a little bit of buying power here, but when we look back, this closed below all of this volume over here, right? You see that? It closed below. It also had the moving averages crossing over, which is an indication that it's weaker. It's starting to fail.
Yep.
And then we had a higher volume. See, this volume is more abnormal than the others right here. So you put all that together, and then this was where it started, but this was more the confirmation of the roll down, right? The next day it gapped up, it actually opened lower. So you could close it out right at open, or you can continue to hold it and swing it. Then you have this candlestick right here, and it came up and it closed above over here, and we had higher volume. So it closed strong on the day, higher volume, up the hill we went.
Okay, what moving average is this? This light purple.
We have the 4 EMA and the 8 EMA.
No, all the way at the bottom. You see what
This one? 125.
125? Okay.
Mm-hmm. All right. So futures. We'll be fast because we got just a little bit more time left. So futures are going to be a physical contract to buy or sell a commodity. Basically, it's a physical item, right? So they have it for currencies, for energy, meat, grains, metals, interest rates for bonds. It would be purchasing of bonds or selling of bonds, and soft fiber futures. So it's an actual contract that you can trade, much like warrants. You look like you've got this cloudy look on your head, like you're confused.
You talking about futures?
Yeah, I'm talking about futures.
Oh man, I know. Whenever I think about futures, like okay, so like whenever I go and post futures to my the people that I follow or whatever, I'm thinking about it's just okay. It's just telling us how the future is looking. Like is the future looking green? Okay, I didn't know it was actually like a contract.
It is an actual contract, and it's like an options contract. So an option is an actual contract as well. And a
Right.
warrant is an actual contract as well, and futures are an actual contract.
How do you buy?
However, these are instruments that you can trade, and you can trade them electronically. So if we go forward, right? So for this one, the product would be corn, right? So she's willing to buy corn on a specific date. So like an option, they have different dates, and they are 12 different month contracts. And maybe she wants to buy 5,000 bushels, and it's $1.450 per bushel, right? That would be the total contract. Well, we can have that for the currencies, the energy futures, meat, grains, metals, interest rates, and again, the soft fiber. And they have them for the 12 different months, right? So that's the code, much like this. We'll touch on it more. I'll show you. So we'll address it more on Friday too, because it looks like you're like, uh-oh, this is not going in. It's not that intimidating, trust me. You don't really need to understand trading futures, but watching them, like you said, is really where they're important,
Okay.
right? So it's really important to see how they're acting, because if, say, the futures for gold are going up, then you would expect all of the gold stocks to go up, right? So you would say, all right, so gold futures are going up, which they did today. So did silver futures. All right, now I know that if the gold futures are going up, maybe I want to look at these stocks and I can trade it symbiotically, right? They're going to go in the same direction. Or if you're trading oil, all right, maybe the oil futures, they just had their announcement. We covered announcements, right? That maybe their announcement came out and all of a sudden there is a surplus of oil. And so all of these stocks are going down. So when the oil futures are going down, you'll see that many of the stocks will trade in the same manner. So it's also important to understand, if you are in an oil stock and it's a Wednesday and the oil announcements are coming out, you need to be aware so that you are able to either get out or protect yourself. If you know, buy a put if you're in long, say you're in a whole bunch of Chevron stock and you might want to protect your shares, you could buy a put to protect your shares so that if it went down, then you're making money on the put while you're holding your longer term shares. Did I really confuse you?
No, it makes sense.
Okay.
Just that, just the whole buying futures and all that. That's just okay.
So here, I'm going to show you as well. We have silver over here on this side, and I'm going to put up SI, the silver futures, so that you can see how it will trade many times in the same fashion. This is 45 minutes, and this will be 45 minutes now. So look at how SI1, oh, excuse me. They are exactly the same because it's the same one. But look at how this is the ETF that you can trade for silver, right? And we have the price action starting, okay, here's 645. We'll do this. Vertical line. So this is basically the price action, and we'll make it easier, 15 minutes and 15 minutes, right? So we have the price action on the silver futures, goes up, pulls back to the moving average, goes up and pulls back. Look at the stock. It's trading exactly like it, right? Here's our open down here, our open, it runs up. Yep, we have that over here. It pulls back. Yep, we have the same pullback. And it goes up. Yes, we have that. And it pulls back. So you can also trade the SPY in relation to the E-minis, right? So here we have a 15-minute chart on the SPY. And here's our 15-minute chart over here. And the SPY future contracts are what you said. They will show you the future in anticipation, right? So if you start to see this going up, but you don't see the SPY going up, there's some manipulation there too. And it will likely be that the SPY will follow.
Oh.
All right. So you can use it as an extra sort of indicator that, hey, if this is going up, then I'm anticipating the SPY to have that same movement, right? So ES would be for the SPY. NQ is going to be for the Qs. You can see here we tested the high of pre-market at 630. Yep, we had a high at 630 over here as well. Tested it. Once it broke above over here as well. So you'll see that they will trade very similarly. However, if they are off, it's usually the ETF that's lying. Yeah.
Okay.
All right. So let's go back here. I think that's, successful traders, right? This is exactly you. Educated, prepared, you're mitigating the risk, you're learning from any mistakes, you're adapting, and you're holding yourself accountable. Unsuccessful traders, opening up that account, not doing any sort of research, just winging it, right? I got this. Yeah, no problem. I saw people on Twitter, they made lots of money. Let me try this. Yeah. Okay, that's not going to work. You're going to continue to repeat failures without studying your own action. And then you're not adapting at all. All right. So day trading can involve a little bit more risk because you're going in and out rather than swing trading. Sometimes swing trading can have bigger gains to it because in the middle of the day, it can trade a certain range and then they gap it up. So sometimes you'll see that people that swing trade actually have larger gains than those people that day trade. All right. And bottom line, I love this. How many times have I asked you not to interrupt me during my mid-morning profit taking? This is me with my husband. Blinders on, stay focused, right? And don't be this short guy that's eating. I need to change these. Don't be the short guy that's positioned too large